Okay, welcome to the show.
Oh,
So I'm taking over for Peggy today. We're going to learn all about real estate things in the Zoom every single Tuesday at 2 o'clock. So you guys go ahead and take it away.
nice. Good to see you again. Yeah. We've done the show before. And so talking to Peggy, we had a kind of a theme that we'd like to talk about today with some of the recent successes that we've had. And so we're Community Investment Group. My name is Chris. This is David on my right and Brett on my left. And we're in the acquisitions, dispositions, and capital of a community investment group. And so we're a multifamily investment company. We're a owner operating forever owner multifamily company. And so as a lot of people know that have invested with us in this group and outside of it, we buy these properties, we transform them from the inside out. We add a lot to the double bottom line of the community. And we've been growing our portfolio on the whole East Coast from now Florida, which is one thing we'll kind of tell everybody about today. But we really started in Virginia. We've moved into North Carolina, Tennessee, Georgia, and Florida. Right now, since we have met some of the group here last time, we were around 3,000 apartments. We've grown to just below 4,000 apartments. We have about 38 different communities that we own and operate. And what we want to talk about today, we've talked about how we operate multifamily before. So definitely any questions on that, we'll definitely go through. But what we want to talk about today is our portfolio purchases and management that we've had, where we're buying multiple properties at once, managing them together, purchasing them together, creating an investment portal together to transform them all at once, and some of the successes that we've had with those, and how we think that's a really good idea to purchase at scale and to kind of open up questions or kind of introduce the idea to it. So, David, I don't know if you want to add to any of that.
Yeah, thank you. I appreciate you having us on the show. So to continue on with what Chris was referencing with the portfolio purchases, there's size and scale when it comes to what institutions are interested in. And so a lot of them are looking at purchasing 200 units or larger. And so they generally have a premium to them because they're a little bit more efficient to run. And a lot of the large groups are very interested in those sizes. And so when you purchase a portfolio of, for example, the last one we did purchase was 172 unit, 120 unit, and another 120 unit all together. Kind of flies under the radar a little bit of your institutional investors that tend to increase that purchase price up, and so you get a better basis, but you purchase them all together, run them all together, as well as getting one loan all together, which banks find a lot more attractive to do. In this case, a $28 million loan versus a 10 million and an 8 million, and still large, but they consider those small loans. And so we like to package those portfolios together. And then you have all the efficiencies of running a larger community, as far as sharing teams, sharing management, sharing marketing. At our size, we're able to have dedicated people for different things like marketing, and then they market to the whole portfolio, and then the cost per unit per property becomes very low.
Yeah, and so high level, what we'll do is we'll just kind of touch a little bit on our track record for how we've purchased obviously a lot of single entity apartment complexes, 1, 2, 3, up to really 700 units by themselves. But we also have multiple examples of track records where we've done 6 property portfolios, 3, and then we'll get into to explain the recent one that we've purchased this year, and we'll go through that. So maybe Brett, it might be a good place for you to take over and kind of tell them about the track record on maybe the 6 property, the 3 properties.
Yeah. So one thing, Dave was talking about on the acquisition side, it is a big advantage, targeting multiple of these smaller properties at one time. There's specific investors out there that only buy, 30, 40, 50 unit properties. And, they will start to scale, slowly, but they'll end up having a couple hundred units after a couple of years, but they're all these smaller properties. And a lot of these institutional investors, like Dave said, may only look for, 100 plus or 200 plus units. So they're not really looking at these smaller units. And sometimes, those operators that have a couple hundred units may want to sell a bunch of them, at one time. And it's an advantage for us to go and target some of those owner operators that may have a portfolio of 500 and want to get rid of 200 of them at one time. But if someone came in and only offered for one property, it's a little different of a disposition than if someone came in and offered for all 200, but it's 4 or 5 different properties. So it's an advantage to them to sell all at once, and advantage to us to get scale while also getting multiple properties at one time. So yeah, like Chris said, I'll go over a little bit about our track record. So we've done this a couple times now. Our first portfolio deal we did was a 6-property portfolio, and we bought that in, what was that?
August 2022.
August of 2022, yeah. And then refinanced that in June of last year. And the purchase price there was 16 million, a little over 16 million. And our pro forma that we actually made that, schedules out all of, our renovations and what we think we're going to get to in value. Our pro forma had it bringing the value up to 34 million. And after 22 months, we refinanced. And compared to that 34 million we thought we were going to get to, we actually refinanced for a value of 35.7 million. So actually beat our pro forma in a time frame that our pro forma was supposed to do it in 3 years. We did it in 22 months. So pretty incredible. We still own it to this day. We want to own all our properties long term, so we refinance them and get a cash out refi. So
that's 6 as that example to see why it helps to have the scale, the insulation, which Dave will talk about why the multi-property system works really well. But that's 6 properties. That's 276 units on that example, and that was 16 million to a valuation of 35 million in 22 months. Through our value add system. So, and then also you probably want to tell about the 3 properties.
Yep. And then just this past year, last year, we bought a 3-property portfolio. That one was a total of that one's 198 units. And we purchased that one for a little over 10 million. It was about 10.1 million. And we are currently estimating a refi. We're working through the process right now to get the refinance in about 2 months. For a little over 27 million, and we've only owned that one for a little over a year. So pretty incredible. And those are the 2 that we've, pretty much brought all the way through the process so far. And then we're going to talk a little bit about one that we purchased just 2 months ago that we're just starting on as well.
Yeah. And so we bring it up we wanted to highlight the difference. A lot of people in this group have come along with us on different projects, but we wanted to just kind of highlight it's not a, ooh, look what we did. It's what can we do also moving forward, because right now being at 4,000 units, our company goals are to double the footprint that we currently have over the next 3 years. And we're sizing up a lot of these opportunities. And it's a really exciting way to purchase multifamily. So, because not only to scale can you create a tremendous amount of wealth, but like Brett said, we continue to own these properties. And so we continue to be the stewards of these properties. And for those who know us, or visit us on our Good News webpage at communityinvestment.com, you can see all the things we do in all these communities on a daily basis. We post almost every day. And so it's exciting to have that scale and to be able to do so much with these communities. And so, yeah, and I think another thing we're going to talk about was the one that we just closed this year that Dave, you probably want to touch on how it emulates these deals really well too.
Yeah, thank you. So we really like the extended use LIHTC purchases, which is after a community is built with tax credits, and that's a 15-year tax credit process. Once those credits have been used up, it goes into extended use, and that's when we like to purchase property. It doesn't have tax credits along with it, but we're able to buy for a great per door price. It does have a rent ceiling to it, but we like the idea of operating under the LIHTC limits and the low income housing limits, and it's that affordable space.
Yeah.
Should I go into that?
Yeah, so I don't know, should we continue forward or was there any questions on that? But I mean, we were gonna tell everybody about this particular opportunity. I don't know what's helpful but we can keep going since we've
Yeah.
talked this far. Yeah, would that be good? We'd like to just tell everybody about this one because it's exciting, but you can kind of track it forward as well, so. Yeah. Is that helpful?
Yeah, go ahead and tell us about what you have.
Great.
So this is a 3-property portfolio. It's Liberty Commons, Springfield Crossing, and Holly Ridge. Holly Ridge is located in Palatka, Florida, which is just outside of St. Augustine. It's a senior community, and so as you can imagine, with the baby boom generation, moving down to Florida, we have an actual 200-person waiting list to move into our community, and it's 100% full. It's beautiful. It has palm trees. It has a billiard room, game spaces, and that one is built in 2001. That's 120 unit. That was purchased for just over 40 a door at that community. And we're very excited about that one. Springfield and Liberty are in Georgia, in Columbus, Georgia, and they're actually properties border each other. So those are run as the 172 unit, 120 unit. So they're run as a 292 unit. They both have their own beautiful community centers with swimming pools and playgrounds. But we have one centralized office, and that's kind of what we touched on, where if you had a 292 unit as one property, it would attract those large institutions, but you're able to combine them together and have all those same great things. The unique things about the Georgia properties are they were under LIHTC restriction, which has that rent ceiling. During our purchase due diligence process, that was taken through, it's called QC, or qualified contract, where they approach the state and say, we would like to take this out of the LIHTC program. And the state has an opportunity for 1 year to bring them a buyer. If they don't, it exits the program. So by the time we closed on the property, it had finished that process. And so now those two are just market rate. So we're able to charge whatever we would like for the rents, which makes it a lot more valuable to people. We still, again, like that low income space as far as rent, but it makes it so we're able to rent. There's a large military base right down the road. The lowest level military, E1, their income is too high to qualify to live at a LIHTC community. So normally we wouldn't be able to rent to any of them, but now that it's out of that program, we're able to bring in, amazing military people that make a really nice income and still charge that rent. And so this one has really nice amenities. You've got 2 swimming pools, 2 gyms, 2 playgrounds. That was built in 2005 and 2001. And those ones were, was it 69 a door?
Mhm.
So those two combined were 69,000 a door. Normally a market rate properties built in 2000s would be much higher per door on the purchase price. So we get excited about buying that sort of age property where you don't have all the old cast iron and PEX piping problems and all the things that come along with your 1970s built properties. And we're able to just go in and just make them even nicer, new flooring, new paint, new LED lighting. A lot of time the cabinets and counters are in great shape still because they're not that old. Nice floor plans, very large units. Do you want to add to that?
Yeah, I was just gonna touch on, you guys may be asking to yourself right now, how are you buying these properties for 46 a door and 69 a door? And it's a great question, and it's exactly what I was touching on earlier in this conversation where, these properties, if sold separately, probably could have gotten 10,000 more a door each for them. But this is an owner that we've bought from before, had a relationship with them, and they know that we can execute on a deal. Running through deals, especially in the past year, have been extremely difficult, and a lot of people have not been closing, have been retrading and just dragging deals on until they never end up closing. And so this seller, put trust into us, since we have a track record and, knew that we could take down all three of these together. So that was the advantage. And, putting them all three together was able to get us to a little bit different of a price range than what, they probably could have been sold, separately. So that was just something I wanted to touch on. And another great thing for the two Georgia properties, both properties come with washer dryers in every one of the units, which is a huge point because currently on our properties in our portfolio, we have, I'd say about 70% of our units across our portfolio have washer dryers in them. We put them in personally and charge anywhere between $49 to $99 a month for those washer dryers. And we've learned that single moms spend, all of their time, their Saturday, and more money, to go down and go to the laundromat and wash their clothes. And, wouldn't they rather just have one in their unit and they can spend that Saturday at the beach with their kids instead? So we've learned that they'll pay for it. And the fact that these came with washer dryers in them already is huge. And they weren't even charging for the washer dryers before we purchased the property. So we're not going to immediately, slap on a washer dryer charge to every single tenant that we have at the property. But any new leases, we are going to start charging for those washer dryers and start upgrading them to a better quality washer dryer once we get new leases as well. So it's just another point I wanted to add.
Yeah, so we thought this was a good idea to share this way of purchasing real estate for all those who, are interested in purchasing real estate on here, or those who are invested in, looking to invest in it. It's a great way to be insulated with your purchase. If you're an investor with us, if you've invested before on some of these deals, it's a great way to be insulated with your investment as well, because you're diversified across multiple properties, multiple portfolios, essentially doing the same thing, 90+% occupied units at incredible basis that because we're able to purchase it like these guys just said, it really does a great job of protecting that investment, protecting the asset that we're purchasing. And it's a fun way to purchase real estate. So it's a kind of a niche. And so we thought it'd be a good idea to share our successes on it and let you know about this 412 unit that we just closed on this year that has the opportunity for anyone who's interested in joining us on it. So.
Yeah, and I'll just give a couple updates for anyone that has seen us before, but we've implemented last August. We went into a little bit more of a, if you think of each location as like a franchise. And so you think of, say, Chick-fil-A, and the individual locations don't decide how they're gonna create the chicken sandwich or the fries, the shakes. It's provided by corporate, and that just sets that location up for success. And so everything is run through the corporate office since August, and that includes the application process and the vetting that we do on that, which we really dig into the potential residents' paying history. It tells a lot, as well as the ability to pay rent and have a healthy income. We do 2.5 times rent. And when you do your due diligence up front, you don't end up with the problems on the back end. And a lot of owner operators, the managers are incentivized to fill up the community and get to 100%. Well, in some cases, that kind of lowers the bar for who they're moving in, just so that they can show that they have a full property.
Kind of a fake full, right?
Yeah, exactly. What happens with that is you get some residents that don't pay. You have to go through the whole evictions process. It's expensive. Sometimes they get mad and they don't treat your unit so nice. So by the time you get it back, you have to turn that unit again. And when you're purchasing a property with plan for success, you don't plan for renovating the same unit 3 times in 3 years before you refinance. So when you do that, it just throws your budget and your cash flow all out of whack when people don't pay rent, then move out, you have to redo the unit. So we do that work up front, and the result of that, for a while it was, the last couple months we've had this success. Well, now we're going on, it's getting close to a year now. Our delinquencies portfolio wide, for any of you that know your numbers on multifamily, is less than 1% delinquency for almost 4,000 units. It's under $10,000 that 4,000 renters.
It's actually less than 0.5% now.
Yeah. Which is unbelievable for the industry. Industry is about 3 to 5%, which is a big difference. And then that ripple effect of we're not evicting, we're not turning that unit again, just the amount of time saving of the people staying. And so everybody enjoys that vetted neighbor that isn't creating problems, and it makes for a nice community.
Going off of what Dave said there of the centralization, at headquarters and really having a plan going into these projects, especially when you buy a portfolio like this, like the 6 property portfolios, it was 6 properties all around the same size, around 50 units. And having 6 properties in 6 different places and all acquiring them at the same time can be difficult. I mean, that is a big project. And so you do have to have a plan going in. And that's kind of what he's saying a little bit on the centralization part, is that, we had a plan going into these deals as far as, which ones are going to get the best rents if we start there with the unit turns and with our renovations. Like, you got to have a plan as far as, your team can't be everywhere at once. So where are you going to be for renovations if you are doing value added specific ones? Or, what is your CapEx plan? Are you going to do the same unit turns at each property? Are you going to do different ones based on the area that they're in? So, that's just a point as far as these portfolio deals. It's a lot at once. So there are multiple different properties. Everything's going to start, all at one time. So really have a plan going in as far as how you're going to tackle it.
Good point. So yeah, it's fun. We enjoy sharing these things with this group, and encourage any questions or if anyone wants to know anything from us. But thanks for listening. I think that hits those points pretty well.
Yeah, if anyone has any questions as far as investment structure, returns, we can go through that through Peggy. If you guys want to set up an appointment with Peggy, or whether anyone is interested in knowing about that now, I think they normally open up to questions.
Yeah.
Yeah, and I don't know if we mentioned that the last property that we talked about, it is already closed, and we closed about 2 months ago, but there is still room that we are raising. So
yeah, we like the new path on this one where we've closed it essentially with our funds, but allow for that back raise. There's not that, it allows for a more runway to time limit for our investors in the way that we, like to work with people. So.
But it's an advantage for the investor as well now, because their money would start working immediately because it's already closed. So the return would be instant.
Yeah. So again, we're Community Investment Group, and thanks for your time, everybody.
What class are you guys investing in? Are these C classes? So they're pretty cheap per door. CD.
C and B. Yeah, I would say CD. Definitely not Class A, but yeah, C and B.
Yeah.
That we infuse a lot of value into to raise that level as well.
I personally call it a B plus. I mean, if you didn't know better, you go to the community. It's beautiful. It has all the amenities of a Class A community.
Yeah, if you looked at the pictures of these communities, these are 2000 build plus. I mean, some of these are 2006. I mean, these are beautiful communities, high vaulted ceilings, very nice grounds. These are, you'd be surprised to, I mean, in this case, for these multiple portfolio ones, they're generally not, no one would consider it a C, but B plus is accurate.
The
Yeah, they're
majority-
beautiful, so.
The majority of the upgrades that are needed are the interior renovations that we do, the outside areas. And I mean, the Florida property looks actually like a resort. I mean, it's got a pool with palm trees all around it.
Yeah, I mean, when these are built, they're built with that low income housing tax credit. We don't do any government tax credits. We don't do any of those things. So we're kind of getting it after that fact. But you got to consider when they're purchasing it, they're incentivized to really overbuild these products because the more money they spend, the more of a tax credit they get. So these types of products that we've been personally having the best success with have needed the least amount of maintenance and upkeep because they were built so heavy up front. They almost incentivized to spend more up front. And so it's really a double advantage when purchasing what we've had the most success with.
And then they're run by builders, so, they're kept up, as far as the condition. We just end up getting a great basis because they just keep them full. They don't really, a lot of time they don't really push the rent. They do very well. When you think about having a zero basis in a property funded through tax credits and you're bringing in millions of dollars a year, they tend to get a little, I would say lazy with the rents, and it's easier to not raise the rent, because then you might have some vacancy. And so you're able to take over and really polish it.
So are these cinder block, the one in Florida? I'm very familiar with the area, so.
Oh, nice. That is a great question. I would assume, but I don't want to assume. We can definitely get that answer for you.
And you got it at 40 a door?
Yes.
How'd you get that so cheap? That's a steal.
So it's a senior community, and so that is the only one of the three that still is under the LIHTC rent restrictions. So the two Georgia ones are not, but the Florida one is.
And in continuation of the relationship with them, it's, they exhausted what they were looking to accomplish. They made a fortune even at that price. And, the trust and ability that we're going to close was worth not going to market and really maximizing their proceeds. So
the thing with LIHTC and that rent restriction, when you're running a large property and you have staff and you have a lower rent, there's kind of that tipping point where, because the value is based on NOI, right? And if you have lower rents and maybe a little bit of vacancy, it can quickly get down towards where your NOI isn't that great. But then you take over and you increase those rents and you fill up, and all of a sudden you've doubled the NOI. And that's where we like.
How long is the restriction on that? How many years is left on the restrictions?
That one's got a good amount left. I think it's 2051, I believe.
Yeah.
And how many units are there?
That one's 120 units.
Okay.
It's in Palatka, Florida.
Yep. And there's no deferred maintenance at all. There's no big.
No.
It was built in 2001.
Correct.
So there's no roofs or no HVACs or anything. That I find that hard to believe. That's usually right at the end of we're coming on 24
there
years
was no
old.
immediate repairs necessary to purchase the product. I mean, you have some maintenance that needs to be done, but nothing. And again, when we buy these, we also build a CapEx budget in there to be able to handle the immediate anything immediate. Or
there will definitely be upgrades that we will be making, but there's nothing immediate that we need to come in and it's like a heavy lift right away. But there will absolutely be things that will have upgrading.
Yeah, the three of us were just down there recently and walked the exterior, and you have a mix of HVACs, like some have been replaced already, some are approaching, the end of its life. Obviously, Florida puts some stress on some AC units. But yeah, everything is done with in-house maintenance. So we hire people that can switch out HVAC units. So everything is done, at a lower price point. So that's not too big of a deal for us if the units go bad and we need to swap them out. But that's what we found is you have that point where your NOI isn't fantastic. And so you can get that great basis, but when you increase those rents, all of a sudden you take a $10 million property to 27 million in 20 months.
And are you guys manage them in-house or the third-party management?
Everything's in-house. Yeah, we're 120 plus W-2 employees at this point across our
Wow.
portfolio. So everything is in-house.
Yeah, so we've got in-house legal, accounting team, controller, CFO, in-house attorney, and then our marketing, everything is in-house there. And then everyone on staff is in-house, maintenance, management. We also have an owner-operator model, which we've proven it to be the thing, and that's kind of, again, like the Chick-fil-A model where you have an owner-operator that's above all of your normal staff, and they're just there for the experience and making sure that things are happening that day, and how do we make the community better, and just dialed in. And it's a different level person. We've always found it funny that you'd hire somebody for 50,000-60,000 a year to run a $30 million business, and just hope that it works out. So we put a higher level person that's incentivized through ownership and bonuses to help above the typical management. And so that's I'm a owner operator of one of our local properties. Chris is as well as we have day jobs. So it's just keeping an eye on everything every day. And so it's that focus, right? If you're an owner and you own one property, it's not that big of a deal. But our founder Brad can't be at 40 different properties at once. So that's the next best thing.
How many, so for the 120, how many employees would you have? Like,
that one has two maintenance and 2 property managers, and then we don't have an owner operator for that yet. Actually, the lady that ran it before is fantastic. I could see her becoming one, but the residents just absolutely love her. She hosts all these events and parties, and there's always something going on there. It's a senior community, so.
sure. She's on site with an office and everything?
Yes,
Correct.
yeah.
Oh, that sounds great. And then what's the IRR and what's the returns? And if you want to.
Yeah, so the returns are pretty straightforward. So the minimum investment's 100,000, and we provide a 20% average annual return. And so it's an 8% preferred return. We do let people know upfront because we're investing so heavily into the project and into CapEx that generally there's not that much extra cash flow to distribute to investors. So we kind of let you know that up front.
Yeah.
Yes, it's an 8 pref if we do distribute, but a lot of the time we're just trying to get it done as quick as possible. It increases everyone's returns, which is how we do the average 19 months. But yeah, if you're in it for 3 years, your 100,000 turns into 160,000. We also do a cost segregation on all the properties. So you'd have the negative K1, which obviously we're not accountants or tax professionals, but the history of our properties, a lot of the time that has outpaced the 20% return. And so you get that K1 and you're able to apply that to, offset your gains.
Yeah, that's fantastic. And then what your hold, your average 3 to 5, you got your guys long term, I think you said, right? You guys are forever holders.
Exactly.
Yeah, we create that exit after we've infused that value. We create the exit for the investors. In your normal time frame of 3 to 5 years, people are trying to sell the property. We try to obviously outpace that and do it faster based on our track history, but we create that exit, give everyone a great return so they can hopefully roll it into the next project, and we want to hold it and continue to steward it forever.
Do we do 1031 exchange into something else, or?
Yeah, if someone's come in with a 1031, then yeah, or just you're also your passive investors come in with theirs, you get your full return, and you can then decide how you want to roll that from there. You have a
We
lot more
do,
control there.
we do have people that also self-direct, 401ks and IRAs. So that's a great path. Market is, at unseen levels. And so lots of people have been interested in doing that.
And we have a chief investment officer, Steve, that, all day, every day has those one-on-one conversations with people. It's, no fees or anything like that. It's straight consulting and answering everyone's questions on their own personal basis. That's what he's there to do. And he's fantastic at explaining every different way of doing it and answering all the questions about stuff.
Yeah.
He's very helpful.
He's a wizard and would love to meet with anybody that has, personal questions. He'll walk you through your own situation and, what bucket might be best for you to invest in. And so he loves doing those.
I would also encourage anyone interested to go onto our blog on our website, communityig.com, and you'll see just years and years and years of every day, the things that are happening at our community. It's very unique. Our double bottom line and our giving back to the communities that we own, I think, is like no other. And I could talk for an hour and a half about all the different things that we do that are different there. But definitely, Steve and his wife, Jessica, are, that's why they love working here and that's what they do. And so anyone interested in discussing the impact within these communities that we buy, we can tell you about that as well.
Can you put it in the chat, your blog? And then the other thing, what's the split? So is it 70-30, 80-20 for how much money you guys putting in yourselves?
Yeah. So we always have a minimum of 10%. All lenders, require that.
No. How much money you guys yourself are putting into each deal?
Yeah. So this particular raise is 11 or 12 million. So we're putting in at least 1.2. I know that we're in with 1.8 with the founder, and then
I'm sorry, I misunderstood you. So you put 10% of your own money in every deal.
minimum,
Yes.
yeah.
Yeah, minimum. I mean, now it varies across the board, but yeah, there's some that we've put substantially more money in.
Yeah, this particular one we closed and there's still 10 million available to back raise. So a lot of the time we will close with in-house capital and then back raise, but we basically, we're always all in. So it depends on how many deals we're closing. Our money is deployed in our deals always.
Wow, this is really good, guys. Thank you. And then the last thing, do you do construction fees? What are your fees, management fees?
Yeah, it's a 3% property management fee, and then 5% on construction, and that's going to be because it's in-house. It's our own employees, and so our typical turns are about $5,600 versus $15,000 for what we're able to do. I mean, our in-house is putting in cabinets, putting in counters. They do the tub reglazing. They do pretty much everything except roofing and flooring is done in-house. So the savings to us and to investors is substantial. And so we have that charge. And I think I need to correct myself. It used to be 5 years ago. It's 10, right?
I apologize on the
I
construction.
believe construction is a 10% markup, but I can double check on that for you.
Okay. The 5,600 a door is way better than a lot of, usually it's 12 to 20 nowadays. So.
And these are high quality turns because again, with that forever ownership mentality, we're not trying to put in a cheap piece because we're just going to pay for it later, even after we have investors out. So we really do put a high quality up front.
Yeah, we're putting in the LVP, click together flooring, really nice craftsman, cabinets and nice stuff. Like Chris said, we're gonna own it. So we invest versus spend.
And do you guys do granite? What do you do for countertops, quartz?
We've tried that. So being in the space that we are, we try to see if that would help at all. So we kind of get full And then we start kind of playing around with units, and we'll throw granted in and see if that gets us another $100 or not. But yeah, it's a good moving forward. Obviously it lasts a lot more turns to do stone. So we've started to explore that. And the last purchase that we made was a 32 unit. That's gonna have all quartz counters in it.
Wow, really good. Well, thank you guys, man. This was really good. You guys had it all very polished presentation and everything like that. So
Thank you. We enjoy doing it. Thank you. Appreciate it.
Ted, you got a question?
Now I've got a few from a slightly different point of view. Think about this from the point of view of the passive investor. What is your, or how would you describe your, let's say, ideal passive investor profile?
It's a great question. You want me to answer?
Sure. Yeah.
No, it's a great question. We actually really look into who's investing with us because we're gonna grow that person's wealth. And we really like the idea of we've raised all through friends and family versus institutions. There's people that'll go to a BlackRock and get $100 million check, and who knows what wealth you're growing there. But we really like to get to know like Peggy. We've known her for years and she's fantastic, and we love the idea of her growing her wealth. And so it's just nice people. Like, we love the idea of growing nice people's wealth.
That transparent, friends and family passive investor has been where we've built the company.
Yeah.
And that's where we want to continue to build it because it's been more personal and less, when you go the institutional route, we've explored that and, gone down those paths, and we could have easily done that a long time ago. But we like the idea of where we invest in the community, how it builds the value, but also how it builds the community itself. And we find that if it's institutional and they have this very rigid checkbox of what you can do in your company, and no, you can't have this community event, you can't, this doesn't financially make sense. It's just not a way to build a community. And so we've really enjoyed that passive friends and family bucket that has helped grow our company up to this point.
And doing presentations just like this is the way that we've raised over 70 million. I mean, we're sitting in our big conference room right now. We've hosted, I don't even know how many investor nights here, and just invited, anyone. I mean, we talk all the time about how we just will pass by someone, in public and start a conversation and realize they're a business owner and invite them to an investor night and they end up investing with us. So it really is building the relationships and being able to tell our story. I mean, we honestly didn't go as deep. We've been on the show before, and I've gone deep in just telling our story about our the community transformation and all the different organizations we work with that we invite into our community centers and host learning labs for kids and do all the different events and food drives and invite churches in to host or to do a sermon in our community centers and different things like that, and renting the bus to take the kids to church, or just all different types of things that we love to do. And that's really the purpose and the reason that Brad, our founder, created the company. So being able to tell that story and seeing that the people in the room during the investor nights appreciate the story and really understand that this isn't just, we're just buying buildings and raising people's rent. I mean, we're transforming their lives, because these, live tech deals, the low income communities that we buy, sometimes are high crime. Sometimes they're in bad areas or the previous owner didn't take care of them that well. And so sometimes it's not just, transforming, the actual building, it's making it safer for these people to live in, and making it feel like it's actually a neighborhood that they can go and meet their neighbors and go to an event without, feeling like they're not safe there. So, we love to pour into these communities. And so it's sharing the passion and seeing the investors understand and then jump on board with us.
And we've
Maybe I should
actually,
change the question around a little bit to say, what sort of characteristics would tell you that a possible investor is not a good candidate for you? If money alone is not the only issue.
Well, it would be that. It would be, again, if we're comparing passive friends and family to institutional, we can say we've turned down lots of institutional because that money wasn't right for us for a lot of the reasons that we mentioned. Or if we go into the story that, Brett just explained, the follow-up questions, yeah, that's great. Why do you do bridge debt? Why is that, if no one cares about those things, then that tells us a lot. But, from a passive friends and family investor, I don't know that we have.
yeah, it would just be an investor that would be questioning, why are you spending money on apartment life? For them to live in the community and host these events, how does that increase my return? And things like that, where they're concerned with that double bottom line and where the money is being spent, because we do pour heavily into that community. We very much feel like it does help the return tremendously because the people love to live there. They don't move out. You're not going to find another community that has church 7 days a week within your actual community that the owner operator was a former pastor of a church, that, your kid, if he's falling behind in school, can go get tutoring, to learn how to read, within the community. And so they, I think they're like no other. And so, yeah, I think that would be just not in alignment of the passion that we have.
Does that answer your question, Ted? I want to make sure we're.
Not as well as I was hoping, but let me try a different tack. I presume you're trying to raise capital, let's say, irrespective of the residence of the residence location of the investor. Would that be a reasonable assumption?
Are you asking if
Let's assume
the,
your investor lives at least 1,000 miles away from the properties that you're talking about?
yeah, we have investors from all over the country that invest with us. Location's not an issue.
Okay.
Why does that matter, Ted?
Well, then the question is, how do you keep in touch with the let's say investors who are not local to you?
Yeah, that's a great question. So we actually just this week are hosting quarterly asset report calls. So we have a quarterly report that we send out every quarter that gives you an update on the specific property you're invested in. It'll have numbers on occupancy, move-ins, different updates about what CapEx we may be doing, renovations, or just an overall update about us, CIG, and the property that you're invested in. And we have just started this year doing quarterly calls as well. So we send out the asset report, and then we invite everyone to jump on a 30-minute call and we share, in a little bit more detail what was on that quarterly report that's only 2 pages, and give some updates and open it up to questions. So we let the investors jump on and ask any questions that they have.
And that was three per day for 4 days this week, was literally right here with the founder and the owner operator of that property, and Brett. And it's just running through any questions, any concerns any investor has about that property, giving updates on the company, new hires, exciting things that, maybe weren't going so well. Maybe things aren't going so well at certain aspects, but just we're an open book. So we're here to just make you feel better that we have a plan. It's not just, a number on a piece of paper. There's big plans behind everything that we do. And
Yeah, and our founder's wildly transparent. So I think you'll have a hard time finding someone that owns a company that is as clear and transparent. He enjoys that. It's very transparent. So and he opens those questions up and he enjoys that.
I presume you're a calendar year fiscal, right?
Correct.
The fiscal year is 12/31.
Yep.
How soon after 12/31 can an investor expect a K1?
They have a deadline. Is it April that their deadline is? They close books monthly after the 15th of every month, and then the K1 is
I think
due.
it's March. I think
Is
it's
it
middle of
March? March.
Pretty sure it's March 15th, I believe. That we try and
Because
get all.
the issue for a passive investor is to
April.
have documentation for their own tax reporting. And the
Yeah,
sooner
correct.
after calendar year you can get K1s out, the easier it is for the passive investor. Guy who's
Yes.
waiting for a K1 at the 1st of April starts to worry.
Yeah, that makes
Yeah,
sense.
it's absolutely before April. I think they start going out into February, but every couple days through the beginning of March, and March
So-
15th is
so-
usually all out by.
Sarah, that's our CFO, she worked for a KPMG and she was in charge of 20,000 K1s a year. So she's the one that runs the K1, so she's real good at it.
Let's see. And can you clarify from a passive investor point of view, let's say how much of the property portfolio that you have is, let's say, securing the passive investor amount?
40%.
You said there are 40,000 doors or 4,000 doors rather in your portfolio, but from a passive investor point of view, are we buying into one project only, or are we buying into the total project?
One project only, but like what we talked about today, this is that kind of extra layer of insulation where these are one project, but there are multiple properties inside of one project, adding a little bit extra layer of insulation as well. But it is a per project basis. Each one is its own LLC that stands on its own, and everyone invests in that LLC. And the nice thing about what we were talking about today, the theme of the day is those portfolios, those 3, 4, 6 property portfolios. That's set up as one. So you'd be one investor into that 1 6 property deal or 3 property deal. So
Yeah, so you'd have a percent of ownership directly into those 3 properties.
For now, thank you very much.
yes, sir.
Yeah, thank
Thank
you.
you.
Thank you.
Yeah, so the one we shared today, it would be a total of 412 units. It'd be one deal, you'd be into 3 properties, but a total of 412 units. That, if you did this one, that would be one deal. Appreciate the question.
Thank
So
you.
you're saying, I'm confused. Are you investing in each property or one property or in the whole?
You're investing in the portfolio.
Correct.
Right. For these portfolio deals, correct. You'd be investing in the portfolio. That's right.
Based on the last question I heard, what I thought the answer was, we're investing in a single deal, not the entire company.
That's correct.
There's different portfolios within the company. That's what
So each deal that you're presenting needs to be, let's say, vetted on its own.
Yes, so
Correct.
the Palatka and the 2 Columbus would be 3 properties within one deal. So you'd invest 100,000 minimum, and you would own a percent of all 3 of those properties. And so that's set up as a new LLC for those 3. Does that make sense?
And so,
You clarified that.
yeah, so it's the 3 properties into one, and then you have other properties also that people can invest in.
Right.
Aside from that, so it's not.
they're just raising for this one particular deal at the moment. They own other deals within their portfolio, but right now they're just offering this one particular deal.
Okay, that includes 3 different properties.
Correct.
Yes.
All right. Well, thank you so much. We're a little bit over, but we started a little bit late.
Yeah.
I appreciate all that information. It sounds like a great deal. So
Thank you.
if anybody wants more information, they can reach out to Peggy to get connected.
Yes.
From there.
This was fun. Thanks for listening.
Yeah, thank you very
Thank
much.
you. Great
Thank you so
job,
much.
guys.
Thank you, guys.
Thank
Appreciate
you.
it.
Thanks.
Thank
Have a
you.
nice night. Thank you.
Bye-bye.